everyone had Merry Christmas, Happy Holidays, Happy New Year. I'll try and do a little catch up first and go through what went on at the end of December. We actually had a decent amount of moves in that month, and some of them I'm not only going to recap at the beginning, but it's on some of the surprises for this year. KKR, my friend Henry McVeigh, does a great outlook piece, and I've said I don't really read much research. I like Henry's research because KKR has a global presence. He's not selling anything, and he does a great job of just connecting dots. And I think that's far more important these days than people that are just using data in terms of historical data and business cycles. Big theme with dollar rates this year. I'm going to go through people having conviction entering the year, and I think there's going to be a lot of uncertainty at the beginning of the year. I'll go through some of the surprises. Some of those are things that you've seen me talk about before regarding energy, but I think with the Mag 7, and I'm going to talk about some risks to the job market this year, which I think could be important when thinking about asset classes to be involved in. And obviously, I've talked about it a lot. I will finish on AI agents and the direct connection to an acceleration of Bitcoin, which I still believe is a major theme. So let's go through what happened in December. This is a weekly performance of the S&P. So not a lot's happened in the last 2 weeks. You did have weakness in the early first 2 weeks of December. But overall, after a strong year, there was a little bit of weakness. The headline stuff was really in breadth. So I had mentioned in the last video, but then also in tweets that I was putting out about how bad the breadth had been inside the S&P 500. So eliminating the small cap side and just focusing on the S&P 500, you can see it was a 2% drop in December. And that was the worst breadth drop literally since the capitulation lows back in late 2022. So the market held in there pretty well, but breadth was extremely weak, and that's what stood out. I mentioned that it was the worst breadth we had seen in a month since back in here. I just wanted to highlight this because this is using an RSI on the advanced decline line for the S&P, and we reached basically a really good oversold level. So I think the market, which has already kind of bounced back or consolidated, is probably still got some room. These were important bottoms, although it took a while for these things to play out. But these were kind of important levels. So when you get a breadth signal, I wouldn't ignore it. I do think the market got oversold in there, and that until we get some of the details on what the new administration is going to do regarding tariffs in particular for Q1, I think it's going to have a hard time. Now, I just want the regime update. I still believe we are shifting regimes. The last 2 years were really driven by AI and by an ISM which stayed below 50. So I think that's changing. The new orders side, I showed this chart back there. I'm updating it now. We're still we made a peak here, a while ago in momentum. I showed this before that historically when you get a change in the ISM and the PMI, this is the new orders part of the PMI. We hit the highest level since 22, so this is it inverted. So it's continued to improve here, and I think as the PMIs around the globe, most likely when they show strength this year, I think that's going to be helpful for a reversal in momentum. We did get a MACD sell signal, so we got a crossover, and here the last one we got occurred really in June. We stayed up here in momentum, so a lot of times with momentum, it doesn't just break down initially. Remember, the momentum stuff really started to get hit when the dollar moved, and I'm going to get into that in a little while. So when dollar yen basically fell, that's when you started to get some kind of a change there in terms of momentum. Just another indication that the advanced decline line got oversold. This is using weekly Bollinger Bands, and we had got down to this level. This was through the end of the year. So I just think we did have enough selling for the time being in terms of breadth. I do think there should be a broadening out, but I'll get more into that when I go through the energy side. Just something to note, this is a city surprise index for the US. It has traded down, and again, we were trading down like this until we got into the point of the dollar yen move back in July. So 10-year rates have stayed up here for the time being. Part of that is obviously the pro-growth expectations from Trump. Some of it, I think, is the inflation expectations running higher. But you've had a breakaway from this at this point, and you've seen the surprise index start to come down. I think it'll be important to watch how that plays out. So KKR, I'll try to go through these relatively quickly. The reason I wanted to show you guys about 6-7 charts from this, I think he did a great job again of connecting dots and keeping this as more like a playbook for next year. I still think the market will be higher next year driven by AI, but I do think there's a very likelihood of seeing at least one, if not two, reasonable corrections during the year of greater than 10%. I think it's going to be a more volatile year. I think there's going to be a little bit more inflation fears. I think there's going to be some, believe it or not, some problems or wondering what's happening in the job market too. So he called it glass still half full, which I think gets into some of the problems. The main reason, and again, if you guys haven't seen this, it's an interesting way of looking at it. This is taking the federal budget deficit less the unemployment rate. And we're still sitting at very high levels. This is really to show that the government is still doing a tremendous amount of spending, the types of spending that you usually see after the great financial crisis, recession in 1999, after the war. These are times when the government is spending money to try and help the economy. We're still spending an enormous amount of money at a time when the unemployment rate is very low. And so it's very difficult to be negative on this. Now, I've listened to a bunch of podcasts of doom and gloomers and people talking about recessions. And one of the areas that they're focused on again, and so I'm highlighting this because the economy is great except for the bottom end. And the bottom end or the lowest quintile is having troubles because of inflation. Living paycheck to paycheck when you have inflation going higher, even though the job situation is out there, you can just see that deposit and money market balances across the 80% are still up dramatically since 2019. So the reason you're seeing credit card defaults, the reason you're seeing delinquencies on anything related to autos or anything, it's there, but I do not believe it's going anywhere. Meaning I don't think there's any contagion because we have a top-heavy quintile in terms of the spending side. And as I've said before, I do not believe in business cycles anymore, and I'll get into that more as we go through it. This is just highlighting that, again, when you're looking for the debt, and this is important because when you think about when we've had recessions, sometimes it happens from corporate debt like it did in 2000 to 2003 after all the money by the telecom. Sometimes it happens from the consumer side like we saw in the housing market. Well, the debt-to-income ratio is down considerably from where it was in '07 for all of these, and the slack's been taken up by the government, who obviously you don't have to worry about. They just keep spending money. They don't have a level, or if they do, they kind of show it and then go decide not to be disciplined. We'll see what this year brings. Another thing that highlights this, let's say, asynchronous business cycle or no business cycle is that we are having recessions. So it's very easy for people to focus on the home section. We're going to have declining home prices, it looks like, in Florida, Texas. There's a bunch of places that were overbuilt. But across the country, you still have the situation where I don't think house prices are going to go down at the country level. And so you've got all these different places that normally they'd be lined up in some way that you'd be getting to a recession. What he's highlighting is not just in the US, but he talks about across the globe, you just have asynchronous economies. They're not lined up the same way as they normally would be. Part of that's still coming out of COVID, but part of it is what's happening with AI and what's happening with productivity. He talks about this, since I agree, I don't see a recession. We're a little bit ahead of where the average of when you have rate cuts and you don't have a recession. But the reality is, without a recession next year, the market will find a way to move itself. It may finish, quote unquote, for the year flat to slightly up, maybe even down. But I don't think our job is to try and figure out what things are going to do for the year. As I'm talking about more and more, Each month should be thought of as about 1 year worth of innovation as we go through this AI movement over the course of the next 2 years. It is just accelerating rapidly, and AI agents are going to make it move at hyperspeed, and that's going to start next year. On the capital market side, again, he's highlighting the fact that when you take in buybacks and you take in issuance, it's just a positive situation for the markets. We do not have enough issuance, and we don't have enough debt needs coming across. He makes this interesting point, and this becomes important when everyone is trying to fade the U.S. And get long the rest of the world. And I've highlighted how I just don't understand how people try to pick tops and things like this. He breaks it down differently, and I think this is important. You've got capital intensive, think of it as the Industrial Revolution, versus the non-capital intensive. Think of it as the tech names and the AI names and everything along those lines. This has been going on for a while. They really started to break away after the iPhone came into existence, and this is what I've talked about. This is the software boom. This is where the Mag 7, this is where the US starts to dominate. And so everyone wants to fade this, and although I think we're going to have a momentum shift this year, I don't think this is about the market going down or about trying to pick Europe over the US or trying to go out and aggressively short the dollar, because the story on this is pretty straightforward, which is productivity. So this is a Goldman Sachs one. I mean, these are staggering numbers. So 2015 to 2019, the US was already dominating in terms of increased productivity around the rest of the world. But since 2019, this is what's happened. It's exploded in the US above where it was, and in Europe, the UK, and Canada, it's collapsed. A lot of this has to do with their focus on things that are capital intensive or things that are sensitive to rates. They just do not have the same productivity situation, and I think this is known around the world, but if it's not, I'll just highlight, you can go through the numbers in this side. This was put out in terms of the GDP per share. FT did it. You've got, this was part of the KKR outlook. You can just see the staggering difference, and these are big differences in terms of output per worker. He talks about the GDP per employee. I've talked about revenue per employee on the same way. We're getting into a world now where if you haven't spent money on R&D and you haven't spent money on artificial intelligence, you are going to fall rapidly behind, and that's what's been happening. There's obviously negatives that come in with it. I'm going to get through some of those, but no matter how you go, this is what's coming out. So every time I read someone that wants to sell the U.S., fade American exceptionalism, and I keep talking about these companies that are not U.S. companies, they are global companies that have moats around their business because of the investments they made in AI, and there's just no company right now that can come up and compete with them. I do believe eventually small businesses or small startup businesses will, as AI allows these companies to scale quickly, but we're not there yet. Just more charts on labor productivity relative to the US. You can just see how much they've declined around the globe. There was an article in the Wall Street Journal this week. Again, American workers becoming more productive. As much as this sounds good and it looks happy, in the end, AI agents are going to replace human beings. So it's not going to be great for, let's say, white-collar workers over the course of the next few years. And then on the R&D side, just from the spend, you can see it too. In terms of the U.S. has been spending, China's been growing spend, but the other countries, there's just no spend going on. It's been shrinking over this time period. Again, a lot of it has to do with either austerity or just not having the ability of doing it because of how fast technology is moving. The negative going into this whole year is the fact that sentiment, this is the conference board, it had another tick higher in terms of people expecting higher stock prices. We're up at very high levels. This is it overlaid with year-over-year S&P. I do think year-over-year S&P will continue to move lower over the course of this year, just because I don't think we're going to get another big year up. But I do think it is one of the big negatives going into the year is people are very, very positive, and there's a lot of things after 2 years of multiple expansion that could create some issues, particularly when you have a new administration, that yes, they're going to help with deregulation. Yes, they're going to try and help with growth. I think a lot of the benefits are going to be seen down the road. The question is, what uncertainty are we going to get from the tariffs right to start off the year? This is consumer sentiment on a Goldman Sachs using social media. Again, up here, higher than it's been basically since back in 2019. So we've really taken the sentiment up. And one of the things that the reasons I bring up the uncertainty that comes versus the dollar, like I said, a lot of people are out there trying to fade the dollar. And I think the one way I could see this turning the other direction, other than a recession in the US, which I don't see happening, but that's the way people are kind of coming back to it, is they believe there'll be some sort of a recession, and that's going to cause the Fed to need to turn and cut rates, and that'll get the dollar down. The dollar is overvalued. I heard someone on a podcast, Felix Zuloff, talk about the fact that McDonald's was more expensive now in Florida than it is in Switzerland, which is a pretty good indication that the dollar is high and inflation here is an issue. But I will say that when you go through this in terms of the fair value and people talking about it, you do have a new administration coming in, and I don't think, despite what I've heard a lot of people say, they're going to just want to trash the dollar. I think they've talked equally about the importance of the reserve currency, and I do think they are absolutely interested in thinking about Bitcoin and stablecoins much more so than most macro people that I see. I don't think they've taken into account how much stablecoins matter from their perspective for keeping the stronger dollar, and at a time where the dollar is going to be probably stronger through tariffs. Maybe if there's a grand bargain with China and the currency doesn't move, you could get that. You can see how strong the dollar's been, so it's clearly in a trend, and it's been very strong. I'm sure there's going to be a correction at some point because this is a very strong move. There was a strong move in the dollar during the tariff year in 2018. Stocks did not perform well that year. So this is the weekly moves we've seen in the dollar, and you can see how consistent it's been. We only had one down week, so would not be surprising to see a shift. This chart is horrible. This is the yuan. Had a big down day to start the year off, and it's sitting basically at the lowest level since 2008. And again, the iPhone came into existence in 2007. A lot's changed in the world. China obviously peaked, and now they've been decelerating. They still have problems there. But if Trump is going to put tariffs on China, I'm sure, like they did in 2018, and it's important for you to see this. This was the tariff year. This is what happened to the yuan. It went down sharply. That's the way that I would expect that it's going to happen again if he does do tariffs. One point Henry made, which I think is very, very spot on, because of the tariffs and the use of currencies, you're seeing a move higher in euro vol. So this is 6-month implied euro vol, which is moving higher. This is rates vol. So where people have been focused a lot on rates, I think the bigger move this year, or the thing to look into, is what's happening in the currency markets. That could be the surprise. The currency acts as a drag, but I think it also hurts global companies. And when you have the tech companies that are global, if the dollar is getting stronger, any misses and earnings surprises for the Mag 7, who are obviously spending a lot of money, the dollar is a headwind to them if it's going to continue to get stronger. So just something to keep in mind. This just highlights, this is momentum. This is the Bloomberg Pure Momentum Index, and this is it overlaid with the dollar. So we had a momentum shift and move lower here. That was during the move lower in the dollar, and this was during the yen. So I bring this up just because at some point here, if we did get a move lower in the dollar, I think this is going to be the case, but I also think as the dollar goes higher here, you may see this kind of peak and not move up and trend that way, just because we some point reach a problem with what's happening for the tech companies, and this is another reason why. So inflation is going to be a story this year. I'd be really surprised if it's not. Even if deregulation and a lot of the things that the administration is trying to do from a disinflationary basis comes through, I think they're very vulnerable right now to not being able to bring inflation down because it's already come down significantly. This is just highlighting, again, the inflation by cycle and where we are as of now, or at least where we were through 2023, and how if inflation were to come back, and I showed this chart, this is the 2s, 10s inflation swap expectations. You've basically entered the green zone again, finally, towards the end of the quarter. This is these lines here just show when inflation, when the Fed got involved. So this is when they pivoted. This is when they got rid of transitory. So everything was fine with tech. And then once the Fed turned or gave any hint that they were worried about inflation, you ended up getting the Mag 7, which went down. I'm not expecting anything like this, but we're not talking about a down market if the Fed were to worry about inflation all of a sudden. What we're talking about is a momentum unwind where you get a shift where people are long stuff and short them. I'm now bringing this up because this is where I think the first surprise of this year is going to be, which again is energy. So we've got a power shortfall. This is something Morgan Stanley put in there early in the year for data centers. But over the course of 25 to 28, I don't think people have really started to do the numbers yet on how much electricity needs are going to insanely go higher because of the advancements in AI agents and the move from what we've been doing in LLMs and getting into inference. These are going to take much more power. If you guys haven't been using AI on a regular basis and you don't see how much time it takes for some of these advanced models, you're using a lot of power, and we're going to see a lot of acceleration, and that's why these Mag 7 have been spending so much money on the infrastructure side. It's not just for chips. Now we're entering a point where the power is going to become necessary, and here's what's happened to oil. So this is the front month contract out in February. We reached the highest level so far since October. We're finally trending higher. We made the low in September. I love seeing charts like this where everyone hates it. They're not paying attention to it. There's no reason to be long it. This is also when China started to stimulate. We've seen a change in the Chinese data. Things have moved higher. Everyone wants there to be a big bazooka. There's not going to be one, but if they just put a floor in and they have any kind of fiscal spending, that'll go higher. But I'm really focused more, as I said, on AI. And this is what's going on as a kind of a proxy, at least at this point, for one of the things to watch out on electricity. So this is natural gas. This is the 12-month contract. This is out to 2026, January of 2026. And what you can see is since fracking basically started to take over post the Great Financial Crisis, starting in 2014, we had no time where nat gas, the 12-month contract, traded above $4. Well, it has ripped higher from the low threes into the fours. This is not a weather thing. This is actually going on in a way that is very, very fast. This is actually bigger than what happened coming out here. So nat gas is having a move, and since I think this is not an oil story, this is not a transportation story, this is a power story, this is an electricity story, nat gas matters. And nat gas has an impact on other parts, because here's the oil chart going back to 2015. So there's not a one-for-one. The trend is the same. But if nat gas is going higher, eventually it's going to filter through into the oil market, most likely, particularly at a time when people don't really have a position there. This is the BCom energy, so this is a way of looking at it with everything combined, including unleaded gas and heating oil. We had the biggest monthly move in December since 2023. We had 2 months in a row for the first time since 2023. So we are getting shifts. And in the month of December, something very interesting happened. And this is one of the reasons why the breath was low. And what I think happened in December, this looks like full-blown capitulation to me. So I just showed you that nat gas was rising rapidly. You have the energy complex in terms of commodities going higher in December, the biggest month since 2023, and oil starting on December 5th. This is the energy stocks. This is the XLE. This looks like a liquidation of some sort, most likely some kind of a mutual fund or pension fund, basically throwing in the towel on commodities. And the reason I say commodities, it wasn't just the XLE, it was the XME, which is the metals ETF. So sitting near the highs of the year in November, still sitting in there in December, and then all of a sudden collapses over the course of 2 weeks, and then it stabilizes and does nothing for the month. At the same time that that was going on, we actually had a rally in the Mag 7. So during that month, it seemed like a rotation. Remember, very few, a very small percentage of active managers, mutual funds, outperformed. One of the reasons is they were extremely underweight, the Mag 7, relative to the benchmarks, and since they led, I think this was a capitulation trade in the month of December. I think it's a great sign for energy in terms of getting the bail. And just to show how this is it on a percentage basis, the XLE was down 10%. I mean, it was the worst month since 2023. And remember, it was the best month for the energy commodity index since 2023. For XME, again, the worst since 2022, and that's coming out of, that's when the Fed was raising rates. This is it relative to the Mag 7. So Mag 7 over the XLE, Again, biggest month since 2023. XME, basically the biggest month since since 2020, and this is when commodities were collapsing. So the whole point of this is just to highlight that there was a massive rotation. It looks like it went into the technology names and that people were throwing in the towel on either outperformance, any kind of thing. Those happen at the end of the year where people position for the next year. It could have just been getting back to neutral weight, but whatever was going on, it had a huge impact at a time when there wasn't much happening. In terms of nat gas, I brought this chart up again. This is it overlaid with XLE over XLK. The only time we've seen rallies in XLE over XLK really since the iPhone has been times where nat gas has gone higher. So I just think people should be paying attention to this. I think it doesn't make any sense for people to want to fade the Mag 7 at this point, but the reality is XLE has been blown out, and the weakness for the United States of America, if you're dominating in productivity and you're dominating in AI and you're spending hundreds of billions of dollars on AI, the weakness is that power starts to go much, much higher, and that starts to hurt these names because obviously their pricing of the stocks has a lot to do with where inflation is. And if we start to see headline inflation move higher, remember what happened back there. I do not think the market will fall because I don't think this is a recession thing, and I don't think inflation is going back up to 7, 8, 9%. But I do think from a valuation basis, there is no room for error with the Mag 7. I think this is going to be a year where you want to be long energy and underweight on the Mag 7. This is just showing it momentum chart versus that Mag 7 over XLE. So again, if you start to see the Mag 7, which obviously it got hit in January to start off the year once we had that massive move. If this thing starts to shift, momentum is probably going to have a hard time. Revisions. If oil goes higher, you're also going to see a change in revisions. This is 3-month earning EPS revisions relative to momentum. So this is what is driving the momentum factor. It has been revisions, and revisions have gone higher for the tech names. They haven't gone higher for anything related to the PMI or anything commodity related. So you get a shift in the PMIs, you get a shift in commodities, and all of a sudden you're going to get a shift in this relative revision, and that's going to change momentum. At the same time, the green line here is the new orders. The red line here is the PMI. I can't say it enough. Momentum has worked a certain way since 2022. This is when ChatGPT took off. It's also when the PMI stayed below. I don't think PMIs are going back up here. I don't expect an industrial revolution, but I do think the measures that Donald Trump is doing on deregulation are going to have a very, very big impact. But I also believe that the energy side is going to be a major story, as I've talked about. And one of the reasons, if this didn't get paid attention to, you have to think about when energy became a negative thing. It was ESG, climate change. The big banks are fleeing climate coalition. All the banks basically are withdrawing because Trump has made it a point that this is not going to be the same game as what went on. When you have an administration that's changing things, you have to think about the positions you had on. Even though this is a drill, baby drill in people's mind, and they thought energy prices would go down, I think to restart stuff, to start doing things again, is going to lead to, at a time when power needs are growing, it's going to lead to a lot of optimism on this stuff. And I just think you're going to see higher energy prices, and they don't need to move too much higher. And this comes at a time, again, where these are the earnings estimates and sales estimates 12-month forward. Technology's up here, energy's hated down here. So if you were going to reduce positions and go through things at the end of the year, I just think from a contrarian perspective, you look for opportunities. I've talked about at a minimum that you want to have energy in your portfolio. I still believe that. I think between Bitcoin going higher, stablecoins being used more, and the power needs that are needed from AI, and I can't emphasize it enough, the power needs from AI are a big, big deal. This is where we are in profit margins. The only thing I need to say on this is these guys are spending an enormous amount of money. It is growing rapidly. If this comes down even slightly, the profit margins on the Mag 8, I think you're going to have some problems in the stocks. Even if it's only a 10-15% correction while the market's going higher, it's going to have a massive impact on momentum. Do not fade the fact that the Mag 7 have helped a ton of things in terms of the momentum trade. Again, spending out tons of money, and again, they're spending them out on data centers. So we're spending money for power. We're buying energy. We're buying the ability of doing AI. I just don't think you can like ignore this, what's happened on this. For those of you to shift towards AI agents, a lot of people have said they're not listening to the All In podcast because David Sachs is not on anymore. That's bullshit. Although I like him the best too. There's a lot of good stuff from this week. They had Gavin Baker on, who's really, really good in terms of the AI side. But a lot of the conversations on this, the surprises and everything, were related to robotics and AI and AI agents. And I just think you have to listen to it, if for no other reason that these surprises are really important towards what's happening with AI. It's just really important in my mind. This is an interview also that I would listen to, just because if you were thinking about the impact that AI is going to have, there's going to be a lot of losers that are going to show up this year. I think this is going to be a dispersion year. Satya Nadella from Microsoft spoke on the BG2 podcast. I referenced Jensen Huang, who spoke on that podcast. Another good interview. He made some very headline statements on, including this one. But this AI agents and SaaS changing again, this is a major, major changing point for the world. To have people talk about what's happening with AI agents, I'm in the process, and hopefully it'll be done tomorrow, and I will do a video on it when it's done. But I've been working on a project to basically create bots on the markets, and I'm using AWS, and I'm spending time on a variety of different GitHub already built things, and it's just blown my mind what I've seen already from a trading aspect in terms of replacing people and doing things that I've always wanted to do, but I probably had to hire 10 people to be able to do. So when I get there, I'll show it. But this is what's coming this year. It already is here, and I think it's more from a development standpoint. If you guys want to follow something to just pay attention to, as when we kind of reach a point where the trend has broken, Apple, during its go-go years, post the iPhone, and I think we're in that moment for ChatGPT. The AI stuff is accelerating. This is the 150-day moving average. Apple stayed above it. When we broke here, that was the only real correction, and then we went back above it. I bring that up because NVIDIA to me is the stock. It's not just a chip stock. As long as this is going higher, the S&P is fine. I don't use this as necessarily a momentum thing because I think we've seen the fastest of NVIDIA in terms of the movements. But as long as NVIDIA is above the 150-day moving average, the market is fine. If it breaks below it, I think we're going to have an issue where the correction could last a little bit more. In terms of AI and why this movement into AI agents is so important, I just want to make sure, because I've heard and read a lot of people, mainly people like Felix Zulauf and things like that, that basically think it's hyped. To read a statement from Eric Schmidt, again, he says this all the time, but to say the LLMs are underhyped, not overhyped, I completely agree. The changes that go on each month, people can't keep up with them. What it's going to lead to, and the reason I wanted to bring this up, we are going to have, starting now, because of being able to build bots and being able to do this, I'm working on this. You don't need to work for a company. You can set up your own business. I have my own LLC now, and I'm planning to do a variety of different passive income strategies, a lot of them using AI. So I bring this up because this is going to change the country more than probably people realize in terms of the movement that's happening on AI. The negative side, and this is where there's a little bit of surprise for me, and again, I want to emphasize, I'm not saying this is going to be a recession, but I do think what we're seeing in the jobs market, this is the yearly jobs. So this is the change in number of people employed. So when we get the final number for December this week, this will take it up to just above 2 million this year. We've been stair-stepping lower, but that red line is kind of, let's just say, the high end of where we were. So as long as we hang here, we're just normalizing back. So we're still creating. But the trend's not good recently, meaning we're getting less and less. I believe AI is going to start to have an impact on jobs. I think it's going to happen this year. I think it's going to move into next year. This is going to continue to get people angry. This is going to be a productivity game where the stock market goes higher because, as Henry said, as productivity goes higher, GDP per employee goes up. Well, revenue per employee is going to go up. And not everyone can go out and go open an AWS account, learn Python, and start doing stuff on that. It's not going to be that simple. And I think we're entering that point. So when you take 8 months of jobs, this is the monthly change, you got a lot of small numbers in here now. When you look at it on a rolling basis, this is the 8-month rate of change. We are actually at the lowest level, except for during the recession periods, really since 2011. We may have gotten under here briefly in 2019. The main point is, I think technology and AI is starting to have an impact on on the job market. I do not think we're going to lose jobs. I just think if we were only creating 50,000 jobs a month right now, you think about that from the fact that if power needs are going higher and we have crude going higher at the same time that the job market is weakening, then you've got a really confusing thing of what the Fed's going to do. And that, to me, is not good for tech if the Fed is sitting in a situation where they don't know what to do and they can't cut rates. I think that could be a scare this year. I want to remind you, this temp data just continues to worsen. So this is temp employees overlaid with that index. So the fact that this is going higher means something. The fact that people are not being hired for temporary positions means something. They're not being hired. This is an early indication to me that we're going to see weakness from AI. So just keep that in mind. I think it's going to be a bigger story this year than people realize. I put this up here because if you want more on AI and kind of a broader discussion, Pomp had me on just before the end of the year. We talked about a lot of things. I've mentioned on here how the purest AI trade to me is Bitcoin. I will continue to say it. I also wrote a paper because I cannot believe, being in Twitter, how many quote-unquote smart Wall Street people are still writing the same thing, that it's a scam, that it's a bubble. I just can't believe that it continues. But I wrote this paper which goes through a lot of details that if you haven't seen, I haven't done this before, but I think it's worth at least going through some of the details on this. In terms of Bitcoin, it started, the first transaction is now 16 years old. So this is not the birthday of the white paper, it's the birthday of actually it starting. Why Bitcoin matters, I reference this in the deplorables. This is must read for people if they haven't read. This came out in 2014 by Mark Andreessen. I've referenced it a bunch of times, but I finally decided, after people saying it's a scam, it's a bubble, Mark Andreessen, who knows far more than any of the people that I read on technologies, says in 2 papers, this one, and then one he did in the Washington Post that year, where he basically said the 3 most important points were the personal computer, the internet, and the launch of Bitcoin. So again, for people who want to just continue to fade it, it's good for everyone else, but I think the productivity situation, you're going to have angrier employees this year, and I think anger leads to more Bitcoin prices, and it comes at a time when the government is doing this. So Michael Saylor keeps getting crapped on as well, which shocks me, but nothing surprises me anymore with people who just write anything they want about Bitcoin and don't take the time to spend on it. How can you fade a photo of Michael Saylor, Trump's son, at Mar-a-Lago yesterday? I don't even understand how people can't possibly get. He puts in a cabinet of all crypto people. They discuss stable coins and crypto at the Treasury Borrowing Advisory Committee in October. How is this a scam? Let's just go through the week. Russia is using Bitcoin in foreign trade. Okay, we've got more adoption going on. It's being used in big transactions, which will be it. Whoa, Switzerland, the home of gold, is considering creating a Bitcoin reserve. Petition underway to urge the central bank to start buying. Hong Kong, national reserves just proposed in Hong Kong. Companies starting to do what we've got companies in the US and Japan doing, which is putting Bitcoin on their balance sheets. So again, these companies all must be scams then as well. Max Kaiser did an interview this week. He's, at this point, he's an advisor to El Salvador, which again, they've obviously been benefiting, but he's calling this a Sputnik moment where nations around the world race to accumulate Bitcoin. I've put so many of these things on here that it's impossible for me to go back and even think about them, but it's a reality. And the fact that the US government is trying to lead the way in this and people are still fading it is beyond me. So I still believe, again, I'll say it, Bitcoin is the purest AI trade. It'll be up again this year. It'll be the best performing asset, and it should do really well if the Fed is torn between cutting rates into inflation moving higher, and the government is supporting it. Morgan Stanley, you're finally starting to see some of the houses. We'll see how this goes. There's still a lot of them that don't allow it. NYDIG had a pretty cool thing come out. You're starting to see Bitcoin, in terms of the thought process of getting it out there in the Bitcoin-backed fiat lending market. Again, there's going to be more creativity that's going on, just like Michael Saylor's been doing, in terms of going through it. Volumes exploding. So as people got more optimistic with Trump in, if this is what you call a bubble, then I guess you're getting what you want in terms of volume. Stable coins. Again, this has been one of the focuses I've had in here, is that stable coins need to be paid attention to by everyone. I think stable coins are what makes the government in the U.S. okay with this, because they're buying U.S. treasuries. 98 to 99% of all the stable coins are dollar backed. Has taken the market cap up over $200 billion, and it's growing. So it's just continuing. And to finish up, Chamath, last year on the All In podcast, said the most important trend for last year would be Bitcoin. So this year they had to do their predictions again. It's a whole prediction thing. And this year he said the big trend in 2025 will be stablecoin usage. He went on to talk about how disruptive this will be to Visa, MasterCard, and you really have to go through this and realize the vig that is out there, and why stablecoins are a necessity, and why you have to basically continue to move forward on this. He goes through the numbers and he talks about it hitting 8.5 trillion in transaction volumes. So that's it for me to start the year off. A lot of stuff in there. If anyone has any questions, don't hesitate to reach out. I'll see you next week.